Alrighty, welcome back to the channel of Truth, Trust and Transparency. I have an update on our number, guys. We're getting closer and closer to 2,500, which is my goal by the end of the year. I only need 636. So if you're getting good value from my videos, appreciate it if you could subscribe. We're trying to get to 2,500 by the end of the year. I'm doing that by posting every single day, answering your questions or trying to provide some sort of value. As always, not financial advice. I'm not qualified to give that. I don't have any licenses or any of that sort of stuff. I'm not a mortgage broker. I'm not an accountant. I'm just a property investor who loves digging in and trying to help people. So I got this very lengthy question from a person on Instagram called Simon. It was a freshly created profile for this question. So I'm not too sure if it's anonymous or not, but let's give it a crack because this one is hella interesting and I really enjoyed working through the potential of Simon, his portfolio. I'll read it out and then I'll sort of go through my thinking so I don't get too sidetracked with what's behind me here. But hi Davey, hope you're doing well, mate. Haven't contributed to any comments on your YouTube channels, but have been watching your content along with other podcasts to help improve my knowledge and learn more about investing. Was just wondering, as you're currently doing viewer questions until the end of the year, if you wouldn't mind running through our situation in the hopes of providing some advice. Remember, not financial advice, but used for educational purposes. Take this, speak to with your accountant, mortgage broker, those sorts of people. We're undecided on whether to purchase another resi property or hold off a couple years and go into commercial. I'll outline our situation below. Combined income between myself and my partner of $270,000. We own our PPR outright with a value of $1.3 million and no mortgage. Congratulations on that. That's a big feat. We've just purchased 2 residential investment properties. The first was in March 2024, Mount Gambier, valued at 676. Currently with 618 remaining on the loan, purchase price 590. Second IP, bought December 2024, 784, loan remaining 615. Renting both for $28,000 and $27,000 a year. We have 130K in our offset and are able to contribute between $83 and $9,300 a month into the offset. Look what can happen when you don't have a mortgage, by the way. That is awesome. That's great savings rates. We would have had higher. There's some reasons around that. I won't get into it. Why they don't have more in their offset, some family issues. Just wondering if we should look at grabbing another resi property around 700 to 800 mark, or as these are all negative for a while, if it's best to keep adding to the offset a bit to fund the strategic pivot to commercial worth around 1.5 to 2 mil around in 28 to 2029. We don't have a passive income amount goal, but we would like to invest in order to provide for a comfortable retirement or better upgraded PPOR around 2035 to 2039. Again, 10 years away, which is great. My partner and I are in our early to mid 40s. Originally, we had thought of acquiring another residential property and holding all of them for 4 to 6 years, then sell 1 or 2 of them to help fund the PPR upgrade and rent out our current PPOR along with 1 or 2 other IPs of ours, but building out the investment portfolio a bit further would likely be best for long-term wealth. At our savings rate, even if we did nothing, we would likely have both of our current IPs fully offset within 7.5 years. That's crazy, but would obviously miss out on the opportunity costs. If we went the commercial route in the future, I think a 1.5 to 2 mil could be possible in 2028 to 2029 or 2030 at the latest. We also have over 400K in super. What a bomb to drop, 400K in super, which we could look at doing another commercial purchase with if we purchase commercial in our names or a trust or things went well. Just don't want to risk overstretching ourselves as we aren't spring chickens anymore and would like to make sure the move we make next is smart one for future wealth opportunity. Only regret not entering property investing sooner. Hey, but you're still doing pretty good. Very much interested to hear your thoughts, mate, as I appreciate your knowledge and insights are far greater than ours. Cheers and all our best with your subscriber goals. Simon, I really appreciate it. Congratulations. Saving heaps of money. Awesome. Paid off your PPR. Awesome. Already started the investment portfolio. Mid-40s. Definitely not too late. Now, again, not financial advice, but this is where my mind goes. The first thing where my mind goes is that your super is lazy money sitting there. you want to explore the possibility of a self-managed super fund. When you have $400,000 in your super, it tells me that with 20% deposits, we can go out and easily purchase two $700,000 properties. Now, if we're being very strategic with our super play, we go out and we buy them. We do nothing. So in 10 years' time or 15 years' time, maybe if they're mid-40s, so this would actually be, you know what? These would likely be more. I've undercooked this. I've actually undercooked it, and I'll tell you why. Because I said that you'd buy the two resis, and then once you reach pension age, retirement age, if you're 60, you can get access to that self-managed super fund. You can sell in your super once you reach that age with no capital gains implications, I believe, if it's within your super and you've reached the retirement age. So I said here, the 700s, they double to 1.4 mil. You'd have about 560 of debt owing. And let's not forget, on 270K, making that 12% contribution for the next 10 years, you'd be able to accumulate about 325 worth of cash. Meaning, after you pay off your debt, you'd have 1.6 mil total, and you would have $325,000 in cash sitting in. After you've sold these two off, 10 years time, we haven't paid much tax. It might be, and check that with an accountant as well. I always get, I don't really look too far into, I know I'm a fair way off retirement and super, but just check if you can get it capital gains tax free if you're selling 60. Oh, you got to wait till 67, that one there. But anyway, it'll be very similar. But what you can do with the 1.6 that you've got from the sales of these two properties and for the 325, you can go out and buy a commercial property outright in cash. You could go bigger, but obviously you're not spring chickens. You don't want to take too much of a risk. So if we go out and we buy 1.925 commercial property in cash, that's telling me it's going to yield at about 6 to 7%, $135,000 a year just in your retirement in super alone. So that's a fairly vanilla super play that you can get for 130 grand. I'm going to keep a running tally of how much money we can generate for you guys. $134,000 just in super. Buy two, sell them down once you reach retirement age so you don't have to pay any tax. If you are selling prior to that, you will pay, I believe, 15% tax, so it's not much anyway. So you'll be around that sort of figure, especially if you're 15 years off that or you leave these to go a little bit higher than 1.4. So 134 in super. Now, let's move over to the Resi base. The Resi base, just doing the numbers, is telling me you're a little bit negatively geared here. 15 grand or 16 grand and 16, almost $17,000. It's telling me it's costing you $2,734 a month. So I'm unclear whether or not that is prior to this or after this, but you know, we got to make sure that we don't catch up to how much we can put away. We're not all negatively geared. What I calculated, and if you guys are able to save 130,000 or this amount here, 8,300 or 8,400 to 9,300 per month, you're going to be able to put away a deposit for an investment property each and every single year. Now, remember, always operate with buffers. So put that 5, 10 grand, whatever helps you sleep at night, buffer against these two, just in case they do go empty for a period of time or you have those maintenance checks. Originally, I said, okay, well, in the next 3 years, if you went out and bought 3 properties and then we held them for 10 years, we sold out of them. And then I thought, well, if you only did 3, you'd have 7 years then left of saving 100 grand. You'd be left with $700,000, which is a lot of money. So you can do it a few ways. And why you probably wouldn't keep buying and buying and buying every year for the next 10 years is because, remember, those ones that you buy in years 6, 7, 8, 9, 10, you've got to give them those cycles to be able to go through and grow. There's no use buying them, and this is why a mistake so many of these investors make that they probably don't tell you or you don't realize is that if you keep buying, those properties that you keep buying, you aren't starting the compound clock on those. You want to get in and out of this game as quickly as possible, right? To be able to retire, to build that. But if you keep buying those properties at 7, 8, 9, 10, you then have to hold them for another 10, 15, 20 years to be able to use them in your portfolio. So I went 3 originally, and then I thought, you know what? The numbers look okay. Let's add in a 4th. Now, obviously what we need to make sure we need to monitor is the income and how much money that we have. It's good that we can keep putting cash down in deposits. We don't want to build this house of cards equity on equity, because otherwise this is going to start hurting you a lot if you have an entire house. Like I'll show a classic example. Let's just say you bought a house for $760 that was $760,000 loaned in equity. It'd probably be closer to $800. So $800,000 at 5.5% interest rate is going to cost you 44 grand. Plus expenses, 54 grand. Only renting at 28K rent. 54 grand minus 28K in rent. 26 grand a year. So 2 properties will cost you $50,000 a year. That's half of that. So that's why we wouldn't look to buy on equity and equity, in my opinion. Because you can save so much so quickly, I'd just be using cash to try to get that loan amount as small as possible. So if we went out and we just bought, and working off these numbers, 100 grand, 100 to 110 grand, probably gets us into a $600,000 asset each year, right? Once we pay those costs, we do a 12% deposit, remember that? We sell them then in 10 years' time when they're all $1.2 million, meaning we would profit $520,000 after we work out our cost base. We pay a bit of tax. We come out with about 400 grand clean per property. Times that by 4, 8, 12, 1.6 million. Plus, after the 4th year, you've got 6 years of saving the sort of cash that you've been putting away. 600 grand cash, which leaves us with $2.2 million. You have $2.2 million. Now, the good thing is that these 2 investment properties, you're only, by that stage in 10 years' time, you're probably only going to have 1.2 mil in 1.2 mil in debt, which means you could go and pay these 2 off and have 0 debt against them. In 10 years' time, 4% increases. The rent, they're going to rent for about 40 grand each. So that's $80,000 of passive income. That's $80,000 passive income. I'll take 20 grand off. So I'll say 60 grand in that portfolio. 60 grand just in those 2 properties. Ideally, guys, my personal opinion is that if you can be left with 3 properties, it is the ideal minimum number. 2, you lose half your income stream. 3rd, it just gives you that sort of better opportunity. So I always say, try be left with 3. Now you might say, Dave, I'm not left with 3. This is exactly what else I do. Simon, you were saying that in 3, 4, 5 years time, whatever it was, that you want to go out and have a look at commercial property. I, my friend, think you guys have the opportunity staring you right in the face, and that is PPOR. Go back through my videos and watch the one on debt recycling, where I explain how you will utilize this. Essentially, this is how it goes. You have $1 million of usable equity sitting in this PPOR, right? $1 million of usable equity. Again, we got to think about, and we got to talk to our accountant, mortgage broker, because we're only earning 270. So if we're going out and buying these need to be in structures that will allow us to scale. And same with this play here. But what we can go out and do, we can go out and get $1 million. We can get that equity release against the PPR. I can use $1 million to go and buy a $2.7 million commercial property. Remember, I need about 35% when I'm buying a commercial property. 35% deposit, 30% deposit, 5% of borrowing costs, 5% of those other borrowing costs. So if I went out and did this, right, and we get a $2.75 million commercial property that is renting at a 7% yield, it's going to be bringing in $192,500, right? If the bank is allowing me to lend that money at 5.5%, it's going to cost me, because remember, it's going to be 100% loan, equity on top of the loan. It's going to cost me about 150 grand, meaning I'll have left over $41,000. $41,000 of passive income from day dot if you go out and buy that property. What is even better with this that I've worked out, in 10 years' time, now you can make a decision here and you guys can keep doing this. You could buy this right? And leave it for the next 10 years to try to start to pay itself off. So you could just say, hey, that 40 grand per year, we're just going to pay it off the mortgage, pay it off the mortgage, pay it off the mortgage to try to get that mortgage down. 10 years time, remember in commercial, we also can build in 4% rental increases into the lease. That 192 is going to look more like $270,000. Now, the best part about this, remember, is you can do a few things. We would have $1 million left over from this deal here. Now, depending what you want to do, you can do a few things. You can pay the $1 million off here and with the money that you've paid down, meaning the debt on this property might only be about 1.5 mil on that commercial. If it is down to 1.5 mil, that money's going to cost you 80 grand to give back to the bank in terms of interest. You're bringing in 270, you're making $190,000 per year in 10 years time just from that property. So we add that in, we go $190,000. Then what do? We can do it that way. That's option one, Simon. Or we can also go, and it depends how much. You said you wanted to upgrade that PPOR, but you didn't tell me how much you wanted to look to get. But 1.3 today, again, this is PPR, this is tax-free money. We're selling it for $2.6 million. We have $2.6 million sitting in cash. So you can move a few ways here. You can go out and get a small loan against that property, potentially. Or if you want to take the $1 million from here and put it up there, that would give you $3.6 million, right? And the money that you've saved in that time, that 600, 4.2 mil you could buy. 4.2 mil you can buy, then you'd come out and say, what is this? You could go out and say, all right, we've got 4.2 million, we're going to buy that. Again, look at where you want to buy, do those future projections on that growth rate and see what it's going to be in 10 years time, just so you don't surprise yourself. 4.2 mil, that may mean as well, that, okay, this loan here has potentially only paid itself down to, let's call it 2.5. So if we have it at 2.5, I'll work it out quickly in my head. 2.5 tells me that it's the money, 2.5 mil tells me that the money is going to be about $140,000 a year. If we didn't pay any of this down, if we just used for 10 years, that 40 grand to pay down that mortgage, and we didn't put any of these sales against it. 140 grand, I just said the rent was going to be at 270K, meaning I make 130K on that asset. So it could be either 190 or 130. Just depends what you want to do with your PPR. But let's add these together. So that's anywhere between 384 to, that's anywhere between 324,000 to 384K. So between $320,000 and $380,000, give or take, obviously, with a PPR of about 4 million paid off in cash. Not bad if you can get it, Simon. Congratulations. Some things to think about potentially, some things to share with your partner. Again, super play, quite easy, mundane. We can go pretty hard here on the PPR. The good thing is as well, it's underpinned by the resi portfolio, and it's underpinned by how much money that you can save should you have any vacancies. And again, depending how these assets perform, you might be adding a third one in there if you want to go for that fourth or fifth. But definitely an option, definitely something to think about. And congratulations on good income and good savings rate. Thoughts, questions, emotions, guys, let me know in the comments. If you got value from this and you go, fuck, you know what, that wasn't too bad. I really appreciated Dave's level of thinking. Help me get 636 down to 0 by the end of the year by hitting subscribe. If I need to work for it, let me know also. But as usual, guys, I'll see you tomorrow.